Welcome traders. Today we are going into the charts to understand the concepts towards navigating the market. An account with a broker or charting software is needed to enable you gain access. When selecting a broker, you will encounter various options with differing features such as spread, width, commission, and so on. So endeavor to take your time to carefully evaluate and find the broker that best aligns with your trading needs and goals. When setting up your trading account, you have two options. You have a demo account option and a live account option. I'm going to speak about the demo account because I want to let you know why it's important for you to start with the demo account. First is that a demo account gives you an opportunity to trade virtual funds. A demo account is a great place to start because you are able to trade with funds that are not real, which provides you a risk-free environment. It is also advisable or highly recommended that when setting up your virtual account, set up a virtual balance that is similar or close to the amount you are going to deposit in your live account. For example, do not set up a virtual account of $100,000 if you know you are only going to deposit $1,000 in your live account. This will help you get a more realistic experience and able to make you align with the reality of trading with a certain amount. You're going to be depositing 1,000, trade with 1,000 so you get that experience and grow from there. Secondly, a demo account provides real-time data and platform familiarization. The beautiful thing about a demo account is that you have the same access to real-time data that one has with a live account. This way, you are able to get a total feel of what happens in the market. You're able to familiarize with it. You're able to know what it is for pips to be going in your way and pips to be going against you. It's better for you to learn that with money that cannot be lost than going through that learning process with money you can lose. Third reason for using a demo account first is for strategy testing. A demo account gives you the opportunity to test your strategy properly, get comfortable with it before you start trading real money with that strategy. Next is confidence building. After, when you already understand the real-time data of how market works, you've already tested your strategy, you will have some confidence that would enable you operate better when you're trading your live account. So this is why it's important for you to start with the demo account. Now, before transitioning into your live account, you need to first master demo trading. Ensure you do that. Achieve consistent results while demo trading. You need to develop a trading plan. Create clear strategies and risk management plan. I will get into real risk management in another video. I will get into a trading plan in another video as well. When you fund your live account, please ensure that you start with small amounts and build up from there. Also, only trade with money that you can afford to lose, so that if you should lose your account, if you should blow your account, blowing your account means you get a margin call and your money is gone. If that happens to you, you want to be in a position where you can still come back. You want to be in a position where you can still deposit money again and try again. Also, emotionally, it will affect you a lot less. So please, it's very important that you only start with little amounts of money, build from there over time, and only trade with money you can afford to lose. Lastly, do everything within your power to monitor and adapt on a consistent level. You need to continuously evaluate your performance, adjust your strategies, using proper risk management and everything needed to be able to get better. We are also going to speak about all of this later. I'm just making you aware before we get into the charts. Next, you will need a charting software, and we have a couple of them. There is MetaTrader 5, also known as MT5, There is MetaTrader 4, also known as MT4. There's CTrader, and then there's TradingView. Most of these are connected to brokers, so when you open a trading account, the broker will give you whichever charting software that they are in affiliation with, that they are connected with, whatever the grammar is that is correct. But I use TradingView. I analyze all my charts and all my trades on TradingView. I think it is better, in my opinion. I think it has a lot more options. TradingView is really great. So you have the ability to analyze in TradingView and then go enter your trades on your broker's platform. TradingView also has some brokers embedded in them, and some people are able to trade directly from TradingView. Anyway, I'm not trying to market TradingView here. It is what I use to chart. So let's get on the TradingView chart. The TradingView chart is a popular platform for charting and analyzing the financial market. TradingView, or charts in general, helps you visualize price movements, identify trends, and make informed trading decisions. TradingView offers various tools to enhance your chart analysis. They offer indicators. There's a wealth of them. You have the RSI, moving average, the stochastic, the MACDs. There's a lot. They offer you drawing tools as well, such as the trend lines, the horizontal rate, the horizontal line, vertical lines, Fibonacci retracements, all of it. They also offer you different chart types. You have the candlesticks, which is what we have in front of us right now. They have the line chart. I don't know how people trade with this, but people do, otherwise it will not exist. Then they have the bars. These bars look so good. If I could trade with this, to be such a flex. But you know what? We're not here to flex. We're here to make money. So let's focus. Charts are used to read market structure. They are used to define risk, set alerts, and execute trades. I would cover structure and risk together, then alerts and trades together, and you'll see why. So when you're reading market structure, firstly, what is a trend? A trend is the bias of a financial instrument in a particular period. You understand a trend by reading market structure. Market structures are interpreted using lows and highs of the market. So low prices and high prices at the market. These lows and highs are properly visualized using trend line. What is a trend line? A trend line is a straight line drawn on a chart to connect a series of highs or lows, indicating the direction and strength of a trend. There are three types of trend lines. We have the uptrend line. This connects a series of higher lows. So there's a low, a higher low. So a higher low is just the way it sounds. A low, a higher low, and a higher low, and a higher low. So an uptrend line is used to connect a series of higher lows. A downtrend line is used to connect a series of lower highs. Show you an example right here. That's the downtrend line. Sorry, the uptrend line indicates an uptrend because the price is going up. There is only lower lows when the price is going up. Think about a staircase. You put your step up, you put your step down. That's lower lows and higher highs. Yeah, these things. So the downtrend line is used to indicate a downtrend. While we have the sideways. The sideways is used to indicate when price is ranging, or also the support and the resistance. So a straight line, which is the sideways line right there, to indicate. So a sideways line used to highlight the lows are the support, while a sideways line used to highlight the highs is the resistance line. A sideways connects a series of similar lows, which are this, and similar highs together, indicating where is the support and the resistance of the market. So trend lines helps traders and investors to identify trends and trend directions. They help to know where to set stop loss and take profits. This is why I said structure and defining risk, or stop loss, take profit, those are all risk. How do they help you define stop loss and take profit? Assuming you are to enter a trade right here because this is a support. And by the way, I like to draw my support and resistance using rectangles. Why? Because this line of support, it just shows the number 23.53, and that can easily mentally make someone believe, oh, the support is at 23.53, so if price goes below, it means it has broken it. No, what I do is, and a lot of people do it as well, so it's nothing too special, I use a rectangle. What I do with the rectangle is that I will collect a series of the lows, because the lows are not always the same. So right now I have this rectangle as my support covering this entire range, so it's not a one line anymore like the 23.53. So right now I will only consider the support to be broken or breaking when price goes below this region. Make sense? And I do the same with my support. So having said that, if one is to enter a buy trade right here, if you are to enter the buy there, you can't just put you can't just put your stop loss anywhere you choose to put your stop loss. You have to put your stop loss in a place where you are certain that if price goes below that in a buy market or in a buy trade, if price goes below that, it has voided the setup. The setup has been destroyed. Or in a sell trade, if the price goes above that, the setup has been destroyed. But you can't just do that for doing sake. You have to have a region, because it's technical analysis. You are technically giving yourself informed decisions. So support and resistance will help you know that if I'm entering a buy trade here, my stop loss has to be below the support. That is how it helps you to define your risk. Then you can be able to see and tell yourself, oh no, this stop loss is too much for me, or it's okay for me. Well, we'll get into that when we're speaking about more about risk management, because risk management is a whole series of lectures on its own. So trend lines also help you determine, help you make the informed decision and helps you understand more of the market dynamics. Please remember that trend line is not exact science. That is even the reason why I draw with rectangle, because it's not an exact spot. It's a visual representation of market sentiment. So sometimes the price might even go lower, and that's what we call fake out. It might go lower than where you expected in a support. It might go higher than where you expect in a resistance. It's not rocket science. It's not exact science. It's not a magic wand. It's just something to give you a thought process. So that is one of the benefits of using a chart, because with using a chart, you're able to read market structure, understanding where is the support, understanding where is the resistance, understanding the kind of trend the market is in, if it's in an uptrend or in a downtrend. That is reading market structure, and you can only do that using the chart. So trade execution. How do you use the chart for trade execution? You use the chart for trade execution and setting alerts, because while you are on this chart, say, what do I use as an example? Now let me go to a lower time frame. If this place right here was the support that is now a resistance, and you want to sell because there was a breakout. Okay. Quick one. Trend lines are used to understand to spot breakouts and possible reversals. So price has been pushing up on the lower time frame, and there's been a reversal of price going down. Now this line right here, which is the support, shows you that price has broken. Let me actually do this. Let me show you this. Let's use a trend line as well. So if you were on the market before this candle, so this would have been 3 p.m. South African time. If you were on the market before 3 p.m. and you had this trend line drawn, the moment this candle pushed down below the trend line and closed below the trend line, that would have given you an idea that a possible reversal is coming. Now, based on that reversal, you could enter a trade right here. Even though it has been pushing up, it's indicated to you that there's a reversal, which when price is going up, the reversal will be a sell. You could enter a trade right here, and you would know that your stop loss should be above the trend line. And because this area is a support, you would know that at this point of this support, you should take out some of your profits, because this is the support and price can reverse. Now, when you take out some of your profit right here and you're still in the trade and price breaks down, you still know that you can allow the trade push to a certain level. So this trend line support resistance shows you, it helps you manage your risk, which you know which is knowing where to close your trade, where your stop loss should be, where your take profit should be. It helps you spot reversals, and it helps you spot continuation of trends. Back to trade execution. So if your intention is to go long, okay, firstly, there are different types of trade execution. We have market order and we have limit orders. A market order is an instruction to buy or sell an instrument at the current market price. It's executed immediately at the price of the instrument at the time of placing the order. So, price right now on gold is $24.57. If I click buy right now on market order, so let me do this actually. TradingView has a nice risk and reward tool. They have a nice risk and reward tool. So if you have this tool open, it's called, where will you have it highlighted here as my favorite? Where will you find it? I've had it here for a long time. So you have it under projection. It's long position, short position. That's where you have it in TradingView. Now, what TradingView? Now, when you have this, if you click on create limit order, my broker is not signed in. What do I do now? What do I do? Okay, pause. I'm going to sign into my trading account and I'll be right back. Okay, I'm in my trading account. So if I create a trade, an order, right here you can see markets. If I enter this trade, let's say 1 lot on gold. If I enter this trade right now and click buy, this trade is going to activate at the value of 2457, because that is where price currently is. This yellow is the price mark. And it's going to enter immediately. But if I think this price is too high right now, I only want to buy gold when it is at 2454, I will then set a limit order for buy. So a buy limit, a market order is an order that activates immediately. A limit order on buy, because when you're buying something you want to buy cheaper, when you're selling you want to sell it higher, right? So on buy, a buy limit is the order or instruction to buy an instrument at a lesser price of where the current price is. So this right here would be a buy limit. I can do this now and just set it buy limit. Now on this buy limit, you can see right here that once price gets to this point, it's going to automatically get into the trade. Still on defining risk, you are able to see ahead of time that on this trade, based on where the stop loss is right now, you'll be losing $1,400 but making $2,500. Don't take this into account. I don't use this kind of big stop loss. I'm just making an example. That will be for buy limits, to buy it lesser than the price. For sell limits, when it comes to sell, the higher you buy, the better, right? For sell limits, if you believe price is going to push all the way up here and that is where you want to sell, then you create a sell limit. You create a sell limit, click on it, When the price gets to that amount, it automatically activates the trade. Then we have a buy stop and a sell stop. So if I am looking for a buy in this trade, because price has broken here, I would only want to take a buy if price breaks above this point. That is the only time I want to take a buy, when price breaks above that point. So because of that, I could say, when price gets here, I want price to activate for a buy. Now that is a buy stop. A buy stop is when you are buying an instrument above the current market value. So in this case, we'll set a buy stop, and by the time price gets to that amount, price is automatically going to buy, and then you are able to see how much you're going to lose or how much you could make. Sell stop, the same thing. If I want to sell in this market and I'm like, if I sell from here, price can get here and reverse back. My only proof that price will push further down is if price is able to break below this point. So in that point, I will create a sell stop. Create a sell stop. This way, when price gets to this point, I am going to automatically get into a sell. So just to recap, a market execution is when you buy on the current price. A buy limit is when you buy less than the current, when you set an automatic order to get activated at a certain value that is less than the current market value. A buy stop is an order to buy an instrument above the current market value. A sell limit is an order to sell an instrument at a specific price that is higher than the current market value. And a sell stop is an order to sell an instrument when the price gets to a certain level that is below the current market price. Quick one. I don't just set buy stop and sell stop because I always want to seek confirmation. So if it's very far, if the price is very far out and I'm not there, what I would rather do is set a price alert. That is why I said I was putting both together. So if I think I want to sell around this point, the best thing I would do is that I could have price set an alert. This way, by the time price gets to that point, it's going to automatically alert. If you have TradingView, for instance, connected to your phone, the moment price gets there, you receive an alert on your phone, then you can go to your chart to see what price is doing at that point to know if you actually want to get into that trade or not. So you see why I group those together, because they are automated. So market execution, price alerts, reading market structure, executing trades, understanding the buyers, all of this, having a clear direction of what market is doing, all of these are what the chart does for you. Say the most stop loss you would have in your own trade is what amount should I put here? 378 pips. Now when you have this here, you can go into a limit order and say one lot is the size. You know what lot is, right? If you don't know what lot is, go to the previous video. One lot, you can see that in this one lot, you are going to lose $378. But you can also see that if you make it in, if it goes your way, you can make $1,639. Now, right there and then you can be able to see and know if your account can afford you to lose $378 and be fine. This is how it helps you define your risk. So if you have $10,000 in your account and you're risking 1% per trade, that would mean you are only allowed to lose $100 per trade. that would mean that this is too much. Then you can know that you need to reduce the size of the trade to say 0.4. When you reduce it, the trade, if it goes against you, you will lose $151. Still too much. You can do this. And then you have 113. This falls within your risk. This is how you can use it to also manage your risk. So your risk to reward refers to your potential loss, while your reward refers to your potential gain, and the charts can help you calculate all of this before entering into a trade. So in conclusion, setting up a trading account, understanding chart analysis, and grasping key concepts like even your commission spread. Oh, hey, do I have the bid and ask price here? Okay, we can deal with that another time. Understanding charts is something that you need to practice and practice and practice over and over and over again. You need to get on, sign up for a trading account, get a chart, get something that you use for charting, this MetaTrader, TradingView, sign up for one of these and just start practicing. Start drawing support, start drawing resistances, sign up sign up for a demo account. Just open a trade, click buy, click sell. Just start getting yourself familiar with all of these things so you can start understanding these basic dynamics, and then you can start being ready for your next level. Now that you've actually seen these videos, you can start watching my daily trading videos and start getting some understanding. But I will try to create another video after this that can make the charts clearer, to make you understand the charts more and make you get better places or better idea of how you trade. Thank you so much for your attention. Wishing you all the best in your trading journey as we go through it together. Remember always, it is a marathon and not a sprint. If you are not committed to sacrifice, if you are not committed to the long haul, please just leave the race now, because you end up with broken bones. Commit to the long haul. Commit to the long haul. Commit to be disciplined. Commit to be able to allow yourself go through the time and spend the time needed to understand this skill. And when you do, you will be happy with yourself.